Welcome to our webcast titled, Is Your Business Prepared for the Impact of the New Revenue Recognition Standard? Brought to you by CFO Publishing and by the sponsor of our webcast, Sikich LLP. I'm Joe Fleischer, and I'm a webcast producer with CFO Publishing. Now what I'd like to do is tell you about our very distinguished panelists and moderators for our webcast. Our panelists are Karen Dorner, partner with Sikich LLP, and Cecil Nazareth, managing partner with IFRS Partners. The moderator of our webcast is Chris Schmidt, Director of Research and Custom Content with CFO Publishing. And by way of background, Karen Dorner, partner with Sikich LLP, has more than 25 years of experience and is adept at reviewing clients' processes and procedures to maximize productivity and reduce or eliminate inefficiencies. And she has gained experience through positions such as CFO, corporate controller, and operations manager for a financial services company, as well as an auditor for a Big Four public accounting firm. Joining Karen Dorner will be Cecil Nazareth, managing partner with Connecticut-based IFRS Partners, specializing in IFRS education, training, consulting, and conversion. IFRS Partners clients include CPA firms as well as small and medium-sized businesses, including subsidiaries of foreign overseas companies. The moderator of our webcast is Chris Schmidt, who is Director of Research and Custom Content with CFO Publishing, and Chris oversees the development of custom content webcasts and other tailored outreach to senior finance executives. And indeed, at this stage, it is now my pleasure to turn the floor over to our moderator, Chris Schmidt, Director of Research and Custom Content with CFO Publishing. Please give a warm welcome to him and to our panelists. Thank you very much.
Joe, thank you very much. I appreciate the introduction, those kind words. I'd like to get us started right off the bat with the questioning for our experts. Question number one is, on May 28th, 2014, the Financial Accounting Standards Board and the International Accounting Standards Board issued their final revenue recognition standard. The standard will affect every company and country around the world. For many CFOs, complying with the new rules could involve big overhauls in their accounting methods and systems, as well as broader disclosures of how companies recognize sales. Before we delve deeper during our webcast today, could you please share a high-level overview of the new revenue recognition standards with our audience? And I think we'll start with Karen, if we can.
Thank you, Chris. Well, according to the FASB, the core principle behind this new standard to recognize revenue is, as you can see on the screen, is to depict the transfer of goods and services to customers in amounts that reflect the consideration to which the company expects to be entitled in exchange for those goods and services. And I think some new terms in here that you're going to want to take note of is the word expects and services to customers. The new standard will also provide improved, which usually means more, disclosures about revenue, guidance for the transactions that have not yet been addressed through other current standards, and guidance for some multiple element arrangements. So they're trying to make this be a one-stop shop for being able to recognize revenue. And I would like to note, too, that because this is an initiative of both the FASB and the International Standards Board, this is principle-based, five-step model to analyze the revenue process and determine when revenue should be recognized. So there's new terms, there's new criteria, there's definitions, and considerations that need to be made to assist in the analysis of when to recognize revenue.
Excellent. Cecil, do you want to comment about the breadth and depth of the impact of this new standard?
Yeah, Chris, and like Karen described, this is really a very far-reaching standard. I would say in the last 5 years, it's the most significant standard that has been released. Good news, the FASB and ISB are talking to each other, and they came out with this great document. I work with a lot of foreign companies and parents, U.S. companies with foreign subs and vice versa, and across cross-border transactions. And I will be honest with you, this is one of the most significant accounting changes with far-reaching implications for the past 5 years. But the good news is it increases comparability across the continent, single framework, and finally eliminates flaws and inconsistencies that have been embedded in U.S. GAAP and in IFRS. and I teach both sides, so I know exactly where the bodies are buried, and sometimes it's even cultural that creates those problems. So, but very important standard, so I urge everyone to take special note and just revisit and dot your I's and cross your T's.
Thank you, Cecil. Let's move on to the second question, which is what was the impetus for the development of the new revenue recognition standard? And Karen, can you take us through that?
Sure. Well, as Cecil mentioned, this is both FASB and the IASB, so it's far-reaching, it's worldwide. And since revenue is the essential measure that stakeholders use to evaluate an organization's current and future performance, the revenue recognition standards that are currently in place, at least for the U.S., are voluminous and for the most part industry-specific and what we would consider rule-based. In general, the convergence initiatives between FASB and the IASB to set standards is so that stakeholders have confidence in the financial reporting is comparable among all companies throughout the world. You know, that they're trying to improve that confidence. So in order to start with the basics, we need to make sure that revenue is recognized consistently across all these different continents and be able to make sure that we can compare things to improve among industries, different entities, and capital markets throughout the world. So the new standard accomplishes this by being principles-based. It's one, like Cecil said, it's one single source of guidance that's going to be used worldwide. And because it's principle-based and there's lots of decisions that need to be made by management to be able to implement this, the disclosures, of course, are going to correspond with all those decisions that management has to make on the different types of revenue streams that each company has in their organization.
Thank you, Karen. Our third question is what are the effective dates that CFOs and their companies need to know and prepare for under the new standard? I understand there are different dates depending on who you are and what you do. And we'll go to Karen for this one, please.
Sure, absolutely. The revenue recognition is going to go into effect for reporting periods beginning after December 15, 2016 for public companies. So that means if you're a calendar year company, that's going to be 2017. This is going to be effective, or and private companies are going to be a year later. There's other information about interim reporting and et cetera. Private companies can elect to do it in the same time frame as public companies, but public companies cannot elect to do this earlier. And quite frankly, I'm not sure why anyone would want to when we start to talk about the implications of some of the questions that need to be answered when you go through the 5-step process. And now that this has been issued and people are starting to review this and ask all kinds of questions and dig into the details of the standard, which is not small by itself, the communication from the standard setters are that these dates might even be extended.
And Karen, could you elaborate a little bit more? Because obviously those are the deadlines. Obviously we have to work backward far in advance of those deadlines to get things moving. Could you talk to us a little bit more about the preparation?
Well, as a practical matter, if you want your financial statements to be comparative, if you're a public company and you're going to be implementing this for 17, quite frankly, I believe, I mostly work with private companies, but I believe public companies have at least 3 years of data that's presented in their financial statements. So that's really starting in 15, 16, and 17 in order to be able to be prepared to have your calendar year 17 year be under the new standards. And because this isn't a change in accounting, you have to do it retrospectively. And we'll talk a little bit later about the two methods that are out there to be able to implement this. But typically, a retrospective change in accounting means you need to do it for all the periods presented, which means basically we're already past the January 1 of 15 when we should be implementing or understanding what changes in our revenue recognition need to be, which is why people are getting kind of excited about this, because we need to know right away what those consequences are. So if there's additional data that needs to be gathered to be able to implement this, we need to start gathering that, quite frankly, immediately for public companies and for 17 and 18 for private companies. And that's why this is so important.
Excellent. Cecil, would you like to comment on this issue?
I would add to that the 1117-2017 for public companies and 1118-2018 for private companies. But let me clarify one more thing. If you're a U.S. company, early adoption not allowed. Okay, I want to be very specific on that. For U.S. companies, public companies, early adoption not allowed. For IFRS companies, so if you're an international company, I'll give you two examples. Your GE, a U.S. company, versus maybe Philips or GlaxoSmithKline, you're a foreign company. Now, for IFRS companies, they can early adopt. Okay, so that's a very, very important distinction in this discussion here. And the second comment I'll make: these are written in stone, but I have a feeling they could delay this by a year. There's a lot of talk about preparedness, and companies like Karen mentioned, 1115. Are we ready? Are we complying with the new standard as we speak? I'm not sure. So there's a joint resource task force that is tasked with this assignment, and my gut is within the next 4 or 5 months they're going to come up with a decision whether we should go with these dates or maybe delay for a year. But it's up in the air right now.
Thank you so much, Cecil. I think we'd like to take a quick break for a moment and move to our first polling question. So let me turn things over to Joe Fleischer to administer our poll.
Well, thank you very much, Chris, and thank you very much as well, Karen and Cecil. The first of our 3 polling questions is the following. Are you confident that your company will be able to transition in a timely fashion to the new revenue recognition standard? That's one reason why we wanted to make sure to cover the time frames for complying with the standard or transitioning to the standard. And what you can feel free to do is select the radio button that corresponds to your answer and then click on the submit button. From top to bottom, the choices are very confident, somewhat confident, not confident. If you don't know, you can feel free to select the radio button next to I don't know. If the question is not applicable, feel free to select the radio button next to not applicable. After you select your choice, you can then click on the submit button. Once again, we want to find out, are you confident that your company will be able to transition in a timely fashion to the new revenue recognition standard? And we'll give you just a few more seconds to respond, and then we will reveal how you've responded. And so far, what we can see is that a plurality, a near majority, in fact, have indicated you're somewhat confident. This is among attendees of our webcast, somewhat confident in your ability to transition in a timely fashion to the new revenue recognition standard. As we proceed through our webcast, we will be able to verify later on whether you still feel as confident later in this webcast as you do now. With that said, we appreciate your responses, and we will now continue our discussion.
Thank you, Joe. Now that we've figured out what the deadlines are, or at least the deadlines as they currently stand are, I'd like to find out why it is so important that CFOs and their companies dedicate significant resources to assessing and implementing these changes. And I'd like Karen to take this one, please.
Sure. The standards consist of a 5-step model, which again is not rule-based, it's principle-based. So there's a shift in how you need to think about the issue. There are new terms and criteria and considerations that need to be learned, and in some cases will require significant management judgment. So there's no bright line test. You don't get to go through the 700 pages of the principle and say, okay, I've answered all the questions, and so this is my answer. There's going to need to be management judgment and documentation of that judgment throughout the entire process. And some of the questions or some of the criteria or considerations are circular. You get to step 3, and it tells you to go back to step 1. So, again, it's not necessarily a linear process that gets you to a definitive answer. And from an auditor's perspective, when management judgment is used, there needs to be an established process that's applied on a consistent basis and controls over that process. And so even though you might feel that you've got this figured out and have made those management decisions, now the task comes to being able to make sure you can apply that on a consistent basis and demonstrate internal controls to make sure that that new process is being implemented. And these types of activities takes time. It depends on the complexity of the contracts, how long it's going to take you to be able to go through the 5-step process. And as soon as you get through the first process, you get to go to the next one. But if something doesn't work in step number 1, you don't have something that complies with identifying a contract with the customer, you basically stop. You don't get to go on to the next steps and see what the answer might be. The answer is you can't recognize revenue. So it's going to be a little bit more cumbersome and, like I said, a shift in thinking to be able to do this. And because of that, there's other modifications that you might need to consider to be able to gather the correct criteria to be able to say you can recognize revenue. So this is far-reaching in not just the financial department. There's general terms on sales to customers that we have on our purchase orders, on our invoices, on all types of documents that we consider as part of our contract with the customer that we need to consider when we go through this entire process. And because you need to consider those other things, not just if you're a general contractor or construction contractor where you do have all the terms in one contract, or at least a group of contracts that are consistent throughout your company's industry, there's those other things that you need to consider as part of the contract in terms of this transaction and the recording of that transaction. So all this needs to be addressed under the new standard.
Thank you, Karen. That's very clarifying. Cecil, is there anything you'd like to add to that?
Yeah, when I'm working with clients, I just re-emphasize to the CEO, CFO, or with the team I'm working with, this is not just an accounting exercise. To me, it's a change management exercise. Like, you got to really understand the implications on the people side, the processes, the technology, the accounting policies, contracts. So it's far. It has to be embedded in the whole organization. One example is, if your sales commission is affected, it's hard to tell the salesperson, if the company is going to defer revenue, that their sales commission is going to be less. Those are issues. So, or the HR to talk about stock compensation. So they are so far-fetched from the accounting and finance function. So you've got to bring a lot of people into this discussion because it is going to affect them and all the stakeholders directly or indirectly. So golden rule, think of it not just as an accounting exercise, but as a fundamental change in business policies and practices.
Thank you, Cecil. I'm sure that not all of us had considered all the areas that are going to be impacted.
Right.
Let's move on to the next question. In general, how will the standard impact companies' financial reporting? And, Karen, can you start us with this one?
Well, I think that what's going to be affected in financial reporting is probably the timing of when revenue is recognized. And because we have a lot of industry-specific rules and have developed industry common practices that we may have more work to do on an entity than someone that has just a simple product that's a point of sale. I go to the grocery store and I'm going to buy these bananas and I give you money and I get the bananas. As the sales process gets more and more complicated, you're going to need to be able to take more time to analyze that. Entities that are going to be impacted the most are those that have the challenges in identifying the performance obligations or the price allocations, such as a technology or software company. But we were talking amongst ourselves the other day about this, and even the concept of a manufacturer or even a retail or distribution company that sells product to a customer, FOB shipping point. There are criteria that you need to identify in the standard that says that the customer needs to be able to benefit for it when you can recognize the revenue. Well, if it's FOB shipping point, the carrier has it, not the customer. So does that preclude us from recognizing revenue? So it could be that, and you think about somebody like Amazon.com, are they going to have to talk to their shippers and make sure everything's delivered within 2 days and then recognize things 2 days later instead of the day that they ship it because it has to be benefit of the customer? All these are questions and things that you can brainstorm on to talk about what ifs and how is it going to be applied, because the guidance doesn't go that deep into how to talk about these things, how to arrange these things. So the criteria needs to be applied to each of the transactions. It could change the amount or the timing of the revenue recognition, and then you're going to have voluminous disclosures to talk about what those things are that have changed from what you've done before and how you can comply under the new standards with the criteria and the considerations for each of the contract streams or each of the transaction streams with customers. So, there's lots of things to consider as part of this. When we talk about the price of the transaction, we have to consider contract warranties, volume discounts, rights of return, valuation allowances. All that needs to be considered, which is a new concept for us. Under the old revenue recognition, revenue was a pervasive evidence of agreement, there was delivery, and that there was a fixed or determinable price and collectability was assured. Under these new concepts, you have to determine what the amount that you're going to collect is, not that it's assured. And all these other aspects come into consideration when you talk about what you're actually going to collect at the end of the process.
Wow, that's amazing. The new standard asks as many questions as it answers. Cecil, what are your thoughts on this topic?
Yeah, I would add a couple. One is, business models have changed, and a lot of the clients we service, we tell them, I know you know what's happened in the past, but revisit. So the business models have changed. So you were selling a physical product, now you're selling on the internet. Now your modes of distribution are different, and so you really want to revisit your sales transaction from soup to nuts. The second comment I'll make is increase your documentation. So no matter how good we think we are, sometimes our documentation is a little lacking. Revisit contracts, for example, and make sure that we are in compliance. So those would be my two comments. First is just revisit the business models if they have changed, and second is the documentation. If you could increase that, it'll help you when you're writing your footnotes, and that would be a major time saver if you understand those transactions a little clearly. And final comment, bring in your salespeople. Sometimes they also have a lot more insight into that process as opposed to a finance person trying to guess, get those salespeople involved and make it cross-functional. That's my point.
Yes, that definitely highlights the cross-functional nature of this whole initiative.
Yes.
Let's move on to number 6. Will the new revenue recognition standard have a significantly greater impact on certain industries? And if yes, how so? And Cecil, I was wondering if you could talk about some different industries and how this may affect them differently.
Yeah, there are several industries, and like I mentioned on both sides, if it is, let's take an example of GE versus Philips on one side. They both sell MRI machines. It would be very, very different in the current standard on the U.S. GAAP side versus an IFRS company on the other side. So, but here are some significant industries that, in my opinion, are affected. So telecommunications, so AT&T, Verizon, they're selling cell phones. So how much of the money do you allocate to the cell phone and how much to the service? That allocation becomes a big challenge. Second, software. When Microsoft sells a software, is it a point of time? Is it a period of time? So there's a lot of variability. Today in U.S. GAAP, there's pretty fixed rules on software revenue recognition. But now you go over to the IFRS side, you're going to be faced with a lot of challenges as to how different companies treat software differently. Copyrights, royalties, licensing, these are all major industries that will get affected. Automobiles, sales versus after sales. So how do we treat sales versus after sales in the U.S.? Under U.S. GAAP, we would create warranties and pretty much cover it, provision for warranties. But in IFRS, they could defer part of that sale of the sales price and say, okay, this is allocated to the after-sales service. For example, it's a 30-year, three-year free warranty, 30,000-mile free warranty. Now, if it's standard in the industry, it's one factor, but if it's not, then you would have to allocate some amount to that, because does that qualify for a separate performance obligation? That's the question to be asked. Now, gym membership, I know it's the new year. Everyone signs up in the gym for the first month, and then the last 11 months, no one is there. So gyms are really happy because they collect all this money up front. Now, question is, do they allocate it ratably over the 12 months, or could you allocate some amount of the first initiation fee, to recognize revenue in that first month, or do you allocate to 12 months? So they always hook you in with free membership in the first month, and that becomes another challenge. And then my favorite industry, the airlines and loyalty programs, frequent flyer miles. You talk about even credit card companies with the rewards programs, and my wife gets suckered into all these programs that they give you the first product free and then charge you twice as much for the remaining 10 products or whatever it is. So these factors have to be borne in mind when you're really looking at the top line revenue number. So I have a feeling from all the list of industries I have gone through, I feel there are a significant amount of industries affected. In the finance sector, that's a total nightmare as to how you recognize revenue. So that would be my take. And even if you're aware of it, I would still revisit those transactions and make sure that you're in compliance with the new standard, or how would it, I call it an impact analysis. How would the current standard differ from the new standard, and what would be your changes on the top line and the bottom line? So revisit your sales transaction irrespective of the industry.
Wow, that's really interesting. Thank you. Karen, I was wondering if you could talk to us a little bit about the relationship of this to the complicatedness of the sales process.
Well, I think that, like Cecil has just mentioned, a number of industries have more complicated sales processes because they have they have things bundled and sold in one transaction to the customer. Another industry that I think has some difficulties is going to be the construction industry with long-term contracts, or any industry that has long-term contracts. As there's more complications to the sales process, there's going to be more analysis and more idiosyncrasies. Variable consideration is something that needs to be considered to determine what the revenue is going to be recognized as well. So that's going to add to the challenges of trying to implement the five-step process. Cecil already mentioned about identifying performance obligations and then price allocations, and some of the industries that he identified have those types of things that are going to add to that complexity, because you're supposed to be taking all those things into consideration and including what's customary for you as a company. So for instance, if you typically offer 2% cash discount on your sales, and your customers typically get it, or even if they pay late, I know that I've worked with a number of companies that give it to them anyway. They're just happy to get the money on time. Even if they didn't pay within the required 15 days, they paid on the 16th day, they'll allow the 2% discount. You're not going to be able to recognize the revenue to 100%. You're only going to be able to recognize it to 98%, because that's customary for you to give out the 2% discount and let people take it even if they pay on the 16th day when your terms say the 15th day. So when you start to add those complexities in, it starts to get a little bit hairy. So that's where we need to go through the 5 steps, and you can't take any shortcuts.
Thank you, Karen. Can you continue to tell us a little bit more about challenges companies will have of identifying performance obligations and price allocations?
Well, for price allocations, like Cecil said, you have to try and understand what the performance obligation is, and determining whether there's one or multiple is going to depend on each contract and what those deliverables are. So you have to take each specific circumstance and look at it individually.
I could add to that also, in addition to what Karen mentioned. So here's a cell phone, and my kids are 16 and 17. They're always looking for new cell phones. So you walk into the AT&T store, and they give you this free cell phone. There's no longer those free cell phones. So there's i6, okay, your iPhone 6. So they're going to tell you pay $200 for this iPhone 6, and your contract is 2 years, and you pay $2,400, $200 each month for the life of the contract. So the question becomes, how do you treat that $200 initial purchase of that handset and what would you allocate between the handset and the service? That's going to be a challenge. And that to me is significant, and the revenue recognition the new standard will definitely have implications on that transaction.
Thank you, Cecil. Our next question is, how do the increased disclosure requirements differ from past revenue recognition reporting? And I think we will turn to Karen again to start us off.
Well, I work primarily with non-public companies, and so the financial statements that we see on a regular basis, the revenue recognition policy is limited to a specific statement. We recognize revenue when a product is shipped, or we recognize revenue when the services are performed or accepted. And that's pretty much it on revenue recognition. You might have a statement about warranty, you might have a statement about right of return, and that you've allowed for that, an allowance for that estimated return in the current year financial statements against the current year revenue. Now, with the new standard, because of all these things we've been talking about throughout the webcast and throughout the 5 steps of the revenue recognition, every management decision is going to have to be disclosed. So you're going to have to disclose, like Cecil said with the cell phone, you're going to have to disclose what the different performance obligations are. You're going to have to disclose what the different deliverables were to the customer and how you have determined when you can recognize revenue and that you've satisfied the criteria and what that criteria is that you believe it allows you to recognize the revenue and when. So every step of your decision-making process and going through this has to be disclosed in the financial statements. So that's going to significantly expand the disclosures. And like Cecil said, make sure you document how you're doing this process, because that's going to be the basis for your financial statement footnotes.
Thank you so much, Karen. Cecil, do you have anything to add on that?
Yeah, I would. One would be on a principle-based system. I work with a lot of companies internationally. So the principle-based system, and they follow IFRS. So in a principle-based system, by nature, you're going to be disclosing more information because there are several options in IFRS which U.S. GAAP does not have. U.S. GAAP is more a binary concept where it's yes-no answers, but in an IFRS system, you're going to have the yes, no, or maybe. So one thing comes to mind non-related to this topic. For example, fixed assets or property, plant, and equipment. In the U.S., it can only be at historical cost, but in IFRS, property, plant, could be at cost or fair value. Now, if you don't mention that, your financials are wrong. So that is an example of a principle-based system, and more disclosures required because there are several options.
Thank you so much. I thought we'd turn now to discussing that actual 5-step process we've been talking about so much. My next question is, under the new standard, what is the 5-step process that companies will have to go through to recognize revenue? What should CFOs keep in mind about this process? And I was hoping that Karen could take a moment to walk us through this process.
Okay, well, on the surface, these steps look pretty simple to understand, and they don't look significantly different than what U.S. companies have been working with in the past. But unfortunately, the devil's in the detail, like with most things, and it's when you get under the concepts into the different considerations that things start to get puzzling and decisions need to be made. So the first step is to identify the contract with the customer. And, of course, there's a definition as to what a contract or an agreement between you and the customer is, and what things that need to be considered with respect to that is they have to be enforceable rights. And a contract can be verbal, a contract can be written. It doesn't have to have exactly all the terms and considerations down, but the bottom line is they need to be enforceable rights. And in this liturgical society that we live in, it's better if they're written than if they're not written. So again, as Cecil mentioned earlier, documentation is going to be key in being able to determine that you're in compliance with these principles from your company basis. So you need to make sure the rights are enforceable and that the rights and obligations have been specifically identified for each of the parties, that the payment terms have been identified, and that the contract has commercial substance. And then the last thing, that the entity is going to be able to collect on that contract. That's for those goods or services that are being exchanged. So that's step one, identifying the contract to the customer. Step two is identifying the performance obligations. And a performance obligation is basically the transfer of the good or service or the deliverable. You know, what did you promise the customer that you're going to do for that exchange? And then there's some underlying principles, and that is it has to be distinct, or if it's a series of distinct goods or services that are substantially the same in the same pattern of transfer. So what's the definition of distinct? The customer, and this is where I was talking before about, you know, how far you can take this, the customer can benefit from the good or service either on its own or together with resources that are available. So if you're adding to something that the customer already has, if they can immediately use it, even though you might not have finished, you know, that's kind of the criteria we're looking at, is it needs to be a distinct, separable, deliverable to the customer for it to be a performance obligation. The transfer of the good needs to be separately identifiable from other promises in the contract. So again, on the surface, that seems to be pretty easy, but when you start talking about free cell phones and service that's over a particular point in time, or free services that are then paid for at a later date, you know, when does that revenue get recognized? It gets a little sticky. Step three is to determine the transaction price. Again, doesn't seem a whole lot different from what we've been doing before. We just needed to make sure it was fixed and determinable. Well, fixed and determinable is not language in this new standard. It's the transaction price is the amount that's going to be collected from that third party. So, if you have discounts, if you have volume rebates, if you have other commissions that are due back to the customer or payables back to the customer, all those things need to be considered in determining the transaction price. And then they've added some additional concepts that you'll need to consider as well, and that is whether you have a significant financing component. Time value of money needs to be considered if this is going to be over a period of time more than 1 year. Non-cash consideration, you know, for contractors, it's not atypical for the customer to pay for the materials and have it delivered to the site for a number of reasons. So is that material isn't necessarily owned by the contractor who's building the building or constructing the asset. You know, now they're saying that non-cash consideration needs to be considered at fair value as part of the transaction price. And again, the consideration payable back to the customer is another concept that's been introduced as being to try and determine what the transaction price is. So if you can imagine that you have a long sales or a long delivery process, or it's going over time and the time is more than 1 year, to have each performance obligation, to have time value of money for when that's expected to be used, that could be very complicated, and our systems don't necessarily support that today. The next step is step 4. You have to allocate the transaction price to the different performance obligations. And, you know, that's where it gets really tricky when you've got these bundled services, whether it's telecommunications or whether it's a construction contract or anything in between. If you've got bundled services, you're a big machine manufacturer, you deliver and install the machine. Is the installation a separate performance obligation or not? If you can't use the machine until it's installed, based on the other criteria we've already talked briefly about, the customer can't benefit. You can't recognize the sale of the machine until it's been installed. So that might delay revenue recognition, whereas in the past, some companies would recognize as soon as the machine has shipped, because the machine was custom made. It was for a specific purpose, and so, you know, they recognize it as a sale and the installation is separate. Now you've got to consider whether you can't recognize the revenue until that installation has been performed and the customer can use it. And then the last one is that you recognize the revenue as over a period of time or as at a point in time as the entity satisfies the obligation. And the assumption is that you would recognize it over a period of time. unless it doesn't meet certain criteria, and then you would do it at a point in time. So you can see just from the general description of these 5 steps that each step, you have to go through each step. There's no shortcuts.
Wow, Karen, that's amazing. There's a huge amount of complexity within those 5 steps. We appreciate you taking the time to share that with us. Our next question is, what implementation issues should CFOs prepare for? How can finance chiefs overcome any hurdles they encounter while making changes? And we'll turn it over to Cecil to talk about this, if you will.
Yeah, from my experience, I've been working with quite a few companies, both domestically and internationally. I'm coming back to that same point. I tell them, look at it like like an ERP implementation, a major systems implementation. You got to embed all the policies and procedures into your organization. Don't just run this through the finance team. You really want to involve a cross-functional team and educate both internal customers from sales to HR to the engineering team if you're in manufacturing, and externally your board of directors, auditors, stakeholders, and stockholders. And you really want to understand what are the implications. And what we recommend and what we do, I recommend what is called an impact analysis. So you write your, what's the impact of the changes from the new current standard to the new standard? How does it affect the top line? How does it affect your bottom line? Those are the questions that are going to come up whether you're sitting in the boardroom or any other environment. So they're just looking at the impact. And so a suggestion towards that is write a footnote and create a financial statement as if you were complying in the new system, provided you have all the data, and then fill in the gaps. And as you start writing your footnotes, you tend to realize there's a disconnect between your financial statement and your footnotes, and then start fixing them. So I would create a financial statement in the new model and create a financial statement in the current model, compare the two that I call the delta or the change. For smaller environments, a little easier. For larger environments, it's very, very complex. But I'd still go back to the drawing board and review all sales transactions. It's as simple as it gets. So, I just saying is easier than doing so. But I do advise companies to take a holistic approach and embed these policies, procedures, and technology into your systems and processes, and that way you'll get a more intelligent answer than making journal entries in an accounting framework.
Thank you, Cecil. Actually, speaking of processes, Karen, could you share with us some thinking on how new processes, controls, and other things are needed to implement this new standard?
Well, I think Cecil said a key thing, and that is if the information is available. And that's probably one of the scariest things about this new revenue recognition standard, is that you might have to be accumulating different information in order to document that your considerations and criteria have been met in order to recognize the revenue. So if you need new information, new systems to be able to track that information, that involves new processes. And whenever you have new processes, then you have to develop internal controls to make sure those processes are being consistently applied and done the same way every time with every transaction that goes into that transaction stream. So that's going to update printed materials. It's going to update people's job descriptions and what's important and what the criteria is. There's going to need to be accounting. And like Cecil said, you're going to want to do simultaneous accounting under the old way and the new way so that you can see those differences and what that criteria is that you're going to need to start tracking. And it could indicate new economic indicators for companies to operate on. It's again, like Cecil said, this is more than past the financial aspect of it. It's going to involve all aspects of the organization. And then, as Cecil mentioned also, you got to address the stakeholders. You got to get the banks and the lenders and the bonding companies and whoever else is involved in helping you with your business to be on board with what those changes are and what the impact is going to be.
Thank you, Karen. Question 10, under SEC rules, financial reports include 2 years of balance sheets and 3 years of operating statements, all following the same basis of accounting. As they adopt FASB's new standard, what should CFOs know about choosing the retrospective method versus the cumulative reporting method? And if Cecil could start us off on this one, I would appreciate that.
Yeah. Here's two methods that has been mentioned in the standard. So it sounds like a fashion concept, retro versus modified retro, and never knew accountants were that funny, but they are. So this is what comes out. If you're doing a retro, it'll be 2015, 2016, and 2017. All 3 years will be under the new standard. So that's how you would go with the retro. Now, if you go with a modified retro, you'll have 2017 in the new standard, 15 and 16 under the current standard, and then you will have to track the changes. Had you applied this it retroactively, what would be the changes had you implemented it on 1/1/15? So the net effect, you still have to keep track of the changes. The differences in the presentation. In retro, all 3 years are comparable because they are on the new standard. In the modified retro, you'll have to do the work, but do not present it. You'll only 17 will be on the new standard. Other 2 years will be on the old standard.
Excellent. Thank you, Cecil. Karen, do you have anything to add on this topic?
Well, private companies have a little bit more flexibility. They might want to consider using the modified retro and just issue single-year financial statements. But that, again, you need to be talking with your sureties and banks and stakeholders to make sure that that's going to be sufficient for them and their analysis to continue to work with the company. But that's certainly something that's been discussed with a number of our clients is do you want to just do a single implement the standard in 17 and only present 17? But again, that's not available to everyone.
Excellent. Thank you. I think it's time for our second polling question. Joe Fleischer, do you have a question for us?
I sure do. This is the second of 3 polling questions we will pose throughout our webcast. The question is your finance team working with other internal departments and or outside organizations to transition to the new revenue recognition standard? What you can feel free to do is select the radio button that corresponds to your answer and then click on the submit button. From top to bottom, the choices are internal departments only, outside organizations only, combination of the above. If none of those apply, none of the above. If you don't know the answer, you can feel free to select the radio button next to I don't know. If the question is not applicable to you, you are welcome to select the radio button next to not applicable. Again, we want to find out from you, is your finance team working with other internal departments and or outside organizations to transition to the new revenue recognition standard? Again, we ask that you select the radio button that corresponds to your answer and then click on the submit button. We'll give you just a few more seconds to respond, and then what we will do is reveal how you've responded. And so far what we can see is that a plurality have indicated that you're working with a combination of other internal departments as well as outside organizations. And indeed, that is a great transition to our discussion about assembling a change management team.
Thank you, Joe. Cecil, I was wondering if you could talk to us a little bit about who finance chiefs should have on their company's change management team.
I think this is really important. So the CFO has to be behind this whole initiative, of course, the backing of the CEO, and dedicate a lot of resources to get this right. So I would put a project manager in charge. Think of the accounting policy person, really get them involved, understanding the new standard and implementing it. IT staff, really important because sometimes there's a disconnect between the finance and IT folks. It's hard to understand what they're looking at, but you want to make sure that your systems and processes can gather that information. I would include HR, sales team, manufacturing. If you're in manufacturing, engineering teams are pretty good and precise in their calculation and computations. If you're in product installation, that's another. For example, if you're in wind turbines or major appliances, you really need some engineering folk in there to tell you at one point of time when the equipment or machinery is usable and completely ready for use, as opposed to just fixing it in the ground. So I would say a cross-functional team would serve the CFO very well.
Thank you, Cecil. Yeah, it is amazing the number of functions that the revenue recognition standard does touch on. Let's move on to our next question. And Karen, I was wondering if you could talk to us a little bit about what steps a CFO should take to ensure that their finance team is ready to lead changes to meet this new standard.
Well, I've got presented here basically an eight-step process that we recommend now so that you can start preparing for the revenue recognition changes, and I'll go through them very quickly, and that is, understand the standard. You don't have to read all 700 pages, but the first 150 is pretty key. Create a project team, as Cecil suggests. You might even need to include your legal in that team if you're actually going to be changing the language in the contracts with your customers. Identify the gaps. Build a timeline so that you have sufficient time to be able to implement things. Consider business practices as well as tax implications. When we have to do our FIN 48 analysis and our tax provisions and our C Corps, those M1 adjustments, which I may be talking a foreign language to people, but I hope not, those M1 adjustments might be different or calculated differently now. So how does that impact the tax return? And then technology considerations are how quickly are our service providers and system providers going to be able to identify and accumulate the new information that we need, and then determine a transition approach. What we're going to do first, what we're going to do second in order to get to the finish line on this. So it's a very comprehensive and far-reaching implementation, and affects everyone in the company.
Excellent. I think, are we off to our last polling question now, Joe? Is that time?
It is indeed time, and indeed this is the third and last polling question for this webcast. The question is, based on what you've learned, how would you characterize, how would you describe the extent of changes required to enable your organization to transition to the new revenue recognition standard? And what you can feel free to do is select the radio button that corresponds to your answer and then click on the submit button. From top to bottom, the choices are wholesale. In other words, the changes may not be manageable. If that applies to you, feel free to select the radio button next to choice A. If you consider the changes to be significant but manageable, feel free to select the radio button next to choice B. And then going down, likewise, small and manageable is another choice. If you don't know, feel free to select the radio button next to I don't know. And if the question is not applicable to you, feel free to select the radio button next to not applicable. What we want to find out from you is, based on what you've learned, how would you describe the extent of changes required to enable your organization to transition to the new revenue recognition standard? Feel free to select the radio button that corresponds to your answer and then click on the submit button. And we'll give you just a few more seconds to respond. And now what we're about to do is reveal how you've responded, and a plurality have indicated that changes are significant but manageable. And what's interesting is that the next most prevalent response, slightly more than a quarter of respondents have indicated the changes are small and manageable. And with this in mind, what we will now do is address questions in the remaining time we have that we've received from attendees. And so now, Chris, I'll turn the floor back over to you and to our distinguished panelists.
Thank you, Joe. Our first question basically asks for our panelists to elaborate some more about what the expanded disclosures required by the new standard are. I understand that moving from rules-based to principles-based means you need to document your decision-making. What are these new disclosures? What will they look like, and how will they be created by finance teams? And if I could I ask Cecil to start, and then maybe have Karen chime in?
Yeah, what I would mention is, so I would go to the standard itself, look at what are the disclosures. There's a whole list of disclosures that are mentioned there. But I would take the trouble to describe we forget the users of financial statements. Often when we prepare financials, we prepare it from a very technical point of view. But if you were to explain that to a person as to how you recognize revenue, so go through each transaction and understand and try to write it in a way keeping the standard in mind. Okay, sales is recognized when the product is shipped or the product is It's when all the performance obligations have been met and the payment has been received. So I think make it a little more user-friendly, and from my experience, a lot of the companies, I read a lot of public and private company financials, and I'm also a professor. I teach at the graduate and undergraduate level, and sometimes we write this so complex, and it's one page of revenue recognition document. So try to, you have to expand on it, but take each line item and make it as clear as you can using the standard as your benchmark. The IFRS companies do a better job because they go line by line and borrow the IFRS standard itself and bring it into their financial footnotes. So that's just some food for thought.
Thank you. Karen, do you have anything to add about that?
Yeah, looking at the standard and some of the examples is going to be key. If you're a public company, you're going to be forging the way, and everyone's going to be using you guys as a model. So as this gets implemented, we'll have more information, and the AICPA is developing all kinds of user guides based on the industry, implementation guides based on the industry, which I would hope would have more information for us as we get closer to the deadlines.
Excellent, thank you. I think we have time for one more question from the audience. I was wondering if the presenters could talk some more about non-public entities and early adoption of the standards for non-public entities. And Karen, did you want to take a look at that one?
Well, for non-public entities, you can adopt at the same time the public entities adopt. So you can adopt starting in 17 instead of in 18. But that's the only wiggle room that we have from from the U.S. standpoint. If you're on IFRS, it sounds like you can adopt earlier. But yeah, the public companies don't get the opportunity to adopt early. They have to stay with the 17 or unless it's delayed by the standard setters. But most of my clients that are non-public are not looking to implement this any earlier than they have to. So, but that is an option.
Excellent, thank you. I guess we have time for one quick question from our audience, and I'll get it to Cecil. Cecil, we have a question asking how the standard specifically will impact professional consulting services. You were talking about various industries before. Do you have any how consulting will be affected?
Yeah, I think it would be the same as pretty close to the current, but I would still go through the 5 steps. Identify the contract, performance obligations, transaction price, allocate the transaction price, and finally recognize revenue. So you'd still go through the same model, but if you're recognizing revenue after the services are delivered, right, then it's the same, but I would still go through. But if it's a contract and your services are delivered over a 3-year period of time, then you would have to revisit what's in the contract. And but I would still go through the 5 steps and make sure you're in compliance with the new standard.
Excellent. Thank you so much. I'm afraid we're out of time, so let me turn it over to our host, Joe Fleischer.
Well, thank you very much, Chris. Thank you very much, Karen and Cecil. Once again, I'm Joe Fleischer, webcast producer with CFO Publishing, and on behalf of our very distinguished panelists, once again, Karen Dorner, partner with Sikich LLP, and Cecil Nazareth, managing partner with IFRS Partners, as well as our moderator, Chris Schmidt, director of research and custom content with CFO Publishing. We all very much appreciate your joining us for our webcast. Is your business prepared for the impact of the new revenue recognition standard? Brought to you by CFO Publishing and by the sponsor of our webcast, Sikich LLP. We thank you for your time, and we hope you enjoy the rest of your day.